Welcome back, everybody. We wanted to kind of review what has been happening in the last week. Quint, I know you wrote a piece on Friday, but obviously there's been a lot of activity today as well.
For sure. I sat down to write an update on that piece. If you didn't get that, we're hearing a lot of people got that went to their junk mail or spam folder, so please do check that out. We wrote about what we thought was going to transpire over the weekend with a lot of headlines and a lot of sort of fear tactics, and that's exactly what transpired. But nonetheless, it was a very fascinating weekend, and then today has been fascinating nonetheless. So to kind of recap a little bit, so everybody's aware, by now you certainly have heard of the two primary banks that have been taken over by the FDIC, Silicon Valley Bank, located in Silicon Valley, California, and Signature Bank of New York, located in a variety of different areas, primarily though in the New York region, taken over by FDIC. Now, there's a lot of speculation going around. Oh, these banks were engaged in just highly risky activities, and that's why the Silicon Valley people are making ties to technology and VCs. I've even heard political discussion about their policies and so forth. Nothing's further from the truth. The reality is Silicon Valley Bank is a bank that took in a tremendous amount of deposits over the last several years, as we saw a lot of tech companies funded. It's a niche bank, but they've been around for 40 years, very well capitalized, very large bank, 15th or 16th largest bank in the United States. At least that was the case until Friday. But nonetheless, served a community of startups. And again, no different than a local bank serving the agriculture community, for example, around here, just the niche that they were in. They took that money and didn't go out and buy mortgages or package products or anything like that. They invested in 1, 2, and 3 year treasuries, as I understand it. Now, this is an evolving story, and we're learning more, but the documents show that they invested in short-term treasury securities. Now, these are considered risk-free assets. I'm not making that up. That's what the academic textbook would call a risk-free asset. So those maturities will mature. Those treasuries will mature, just like if you own a 1 or 2, 3 year treasury, it will mature, it will pay out the interest, and then it will mature at the time of maturity. However, in the meantime, it might fluctuate. And I don't think any of these banks realized that the Fed funds rate or the interest rates would go from effectively 0 to over 4% in a matter of months. When that happened, those securities dropped in value, to the point where the $200 billion they had in assets was down approximately $15 billion. Now, percentage-wise, that's not a massive amount. However, $15 billion is a lot of money.
Right.
Now, for whatever reason, we still don't know really what kicked this off, but all of a sudden money started moving out of the bank. Somebody caught wind of these losses, and a cascade domino effect transpired. Pretty soon, the bank needed to try to raise capital, and then it was a wildfire.
Because if they would have just held the securities, held a 1 year or a 2 year treasury, then those come to maturity and they get back to their value. But because they decreased in price and then they had a lot of money going out, that's when they had to start recognizing maybe some of those losses on the treasury bonds and selling assets.
Oh, that's exactly right, Logan. The banking system in the United States is built on the full faith and credit of the United States. No bank has all of the money on deposit. Most of the time it's lent out. Think of the It's a Wonderful Life scene, Jimmy Stewart telling, no, your money's not here. It's in Jane's house or Billy's house or whatever it may be. And so if we all woke up one day and went to the bank and said, give me our money, the banks don't have it. All right, it's just not there. The reality in this situation is, yes, if they would have just held the securities to maturity and nobody needed their money, everything would have been fine. Nobody would have been the wiser. Unfortunately, that didn't happen.
Right.
Money started moving out for whatever reason. We don't yet know. There's a lot of speculation around that. But ultimately, then what's happened and what's happening currently as we do this is every investor analyst in the world is looking at every single bank and trying to determine how similar they are to that situation. And if there's even a hint of a bank being in the same similar situation, and my suspicion is there's a lot of banks that bought treasuries. It's a treasury.
Right.
We're not talking a massive speculative investment. Now, in hindsight, should they have kept the duration a lot shorter? Yeah, they should have, but the reality is they bought treasuries. So ultimately, these are unrealized losses. This is not '08 and '09 where mortgages are defaulting, people aren't paying their bills, and these things are collapsing. These are unrealized losses. If held to maturity, they will mature at face value. The reality is a bank may not have that amount of time if deposits are going out. So what's happening today? More than just those two banks are significantly, those two banks are gone. Basically, their equity is wiped out. The government is supporting the Federal Reserve, Treasury, and the FDIC have come together to support depositors who have more than the $250,000 FDIC limit. Now, one would ask, why would you have more than $250,000 in a bank? If you're a small business, and especially in this particular situation, and you were funded, and you said the funding, let's say the VC says, oh, we always use this bank, go see Jim. He's a great banker, and he works with all of our startups. He'll set you up and get you all accounts and help you with your payroll and whatever. I'm just making that up, but I'm sure that's the conversation. So they go down, they open the account, money's wired in. That's where their account is. That's where their operational budget is. That's where their payroll account is. So it's held at that bank. So if you're a startup business or a business of any kind, more than likely you have a sizable amount of money at a bank to meet your operational demands. That's what happened in this instance. So what's happening right now is there's a slew of banks that are under significant pressure, their equity prices, because while the Federal Reserve, FDIC, and Treasury bailed out the depositor, they did not bail out the bank. They will not shore up the equity or bond value of the bank. So what's happening right now is people who are concerned about a bank are selling those banks, thinking, well, if this bank is under pressure, maybe they have the same, problem that Silicon Valley Bank. I'm selling my shares in that bank. So we see a variety of stocks trading lower. Now, the irony is the market as a whole is up. And the reason is because this ripple effect in the financial community is a clear sign to everyone that the Fed may have gone too far.
Right.
Who maybe has been saying that for a while. Holy cow.
Yeah.
So the Fed, who just last week came out and said, no, everything's fine, we don't see any problems. Okay, now we have a big problem.
Right.
So interest rates are declining quickly and considerably, which is a positive for stocks, and that's what's lent to the stock market moving higher. Not to mention the fact that we aren't seeing a massive bank run because those institutions stepped in to support the depositor. So I would say a few things. Number one, if you're a small business and you have a sizable amount of money at one particular bank, understand where that bank is. What do they, not geographically, but understand what they're invested in, understand what you're invested in. If you have securities, if you have treasuries or investment accounts, et cetera, you actually own something. You own something. So, if it's maturing, it will mature. It will give you the money, et cetera. If you have institutional money in a bank that's below the $250,000 limit, you're insured, and the government has made it clear that they will support over and above that amount as well. So from an investor standpoint, there's not a lot of overarching concerns here unless you have sizable cash positions in one particular bank with no investments, right? Just in the bank and the bank account itself. That's what's going to be fascinating. Now, tomorrow morning, the CPI comes out.
Right.
We have a flood of data. So the Fed, what's being priced into the market right now is the Fed pausing. No 50 basis
backing
point.
Off big time, yeah.
There's still some percentage that likelihood of a 25% rate hike. We'll see how the CPI goes, but most people are sitting here saying right now the Fed certainly is seeing this. They cannot create additional stress on the system. I'm surprised. They talk every day, and all of a sudden now they're quiet, which is amazing. I think they're actually in a quiet period right now, but nonetheless. But the market is watching the banking crisis very closely. They're watching what the government's doing, and they're watching what interest rates are doing, which are coming down, and that's why the market's positive right now. For now, we'll see what happens.
Anything else you want to add?
No, this goes to what we've been talking about. There's more volatility. There's more things in play. We keep looking at what we're invested in. We keep looking at our portfolios. We keep trying to poke holes, in what we're invested in, where we are. we feel very confident and comfortable with where we are, the diversification, the allocation for managed accounts that have gold and even accounts that have treasuries. We feel very comfortable with all of our positions. There's just a lot of noise right now, a lot of noise and a lot of volatility, and it creates a lot of anxiety. There's no question. You feeling it, we're feeling it. People are asking about their bank, where do they bank, what money do they have in the bank, et cetera. And it's a challenging environment, but we've seen this before. I feel like it just, again, history, as I wrote on Friday, doesn't necessarily repeat, but it certainly rhymes. Sure.
All right, great. Stay safe out there.